Welcome to How to Make Money in Stocks with Investors Business Daily, featuring market commentator and host of the IBD Market Wrap, Amy Smith, and Matthew Galgani, host of the IBD Stock Analysis and editor of the IBD Extra newsletter. Tune in each week as we use history, not hunches, to help you stay safe in today's market and get in early on tomorrow's winning stocks. Now, here's Matthew Galgani.
Welcome, everyone, to another episode of How to Make Money in Stocks with Investors Business Daily. Before we jump into this week's show, we want to let you know that there is a new Investors Corner series on selling. It's called Master This Sell Rule, and we'll have a link to that on our website at investors.com/investing show. Also, the big video game expo E3 starts on Monday, and we're doing a special report that's going to cover the latest video games and trailers and accessories, and of course the latest virtual reality goggles and the games that are coming from Oculus and other companies. So you can check all of that out on our website.
And on the show today, we're going to talk about what to do in between earnings season. But first, let's take a quick look at the market. The market remains choppy and range-bound. You know, it looks like we were going to correct, and then, no, wait, we're going to take a bounce.
I feel like we've heard this before.
And then when you feel like, okay, Wednesday we had the concerns over Greece were sort of abated for a while. The Greek, the German, and the French leaders had gotten together. Things looked good. Stocks were higher Thursday. We had strong retail sales. But then Friday came, and those Greek concerns intensified. We had the European shares and the U.S. shares sold off sharply. So all we can say is range bound. And the other thing that I would say is we have the S&P back below the 50-day and the Dow back below the 50-day.
And the NASDAQ may be heading that same direction. It fell on Friday, but again, this has been such a seesaw market. Who knows what's going to happen next week? But that kind of action is also reflected in some of the leading stocks. I went back and looked at some of the stocks that I've covered in the IBD stock analysis over the last few weeks, and several of them have broken out. But with the exception of Mobileye, which I covered on Thursday, and it had a nice breakout, made a nice follow-up on that on Friday. With the exception of that, the ones that have broken out are just kind of lollygagging right around that breakout point. So, for example, if you take a look at the charts for AbbVie, for Gilead, Illumina, and also Health Equity, which I did on Friday, you'll see that they're right around within maybe 1 or 2 percentage points of the buy point. So it's hard to tell which way they're going to head and if they're going to gain traction or not.
Now, we have the U.S. Fed policy meeting next week. The market anticipates right now a September rate hike. Of course, we will have earnings ramping up next month. We did have some things that were interesting this week, though. We had Mobileye, which Matt covered in the stock analysis video this week. The National Transportation Safety Board called for auto manufacturers to all of them to have these collision avoidance systems in their cars. Of course, we saw Mobileye broke out of a nice cup with handle base. It was up nicely Thursday and Friday. We had newer IPO Shopify, rose 9% Thursday, another 7% on Friday. It broke out of its IPO base. That was nice to see. We had Wingstop, which is a new IPO, as if we need another restaurant chain in the mix, but this one specializes in a bunch of different chicken wings. We got the mango habanero, the serrano pepper, the hickory smoked barbecue, the garlic parmesan. Anyway, that one was up about 60% in its IPO debut.
So as we've been saying for a while now, you can still buy a breakout, a good solid breakout in this type of market, but you do have to keep it on a tight leash. And if you're not sure about how to sell stocks, do check out that new Investors Corner series called Master This Sell Rule.
Imagine a Sunday morning, coffee in hand, you turn on your laptop or tablet, and you see a handful of stocks near a potential buying range. That's what you get with Leaderboard from IBD, a timely watch list put together by our market experts, and it's updated throughout the week with alerts to any buy or sell signals. The results? In 2013, Leaderboard has more than tripled the performance of the S&P 500. So to see what's on the list right now, get a free trial of Leaderboard at investors.com/radio show. That's investors.com/radio show. Now, back to How to Make Money in Stocks with Investors Business Daily.
We talk a lot about earnings season because it comes around 4 times a year. It is a very important part of investing to understand that a lot of breakouts happen around that time or breakdowns because there's a reaction to the company's latest earnings report. But this week, we want to talk about things you can do between earnings season, that little lag time between one quarterly report and the next one. There can definitely be catalysts, there can be news, there can be industry announcements, there can be other things that happen in between, but oftentimes there's less going on with the stock, with the company during that between period. So today we'll talk about a few things you can do during that time and also make sure that you get prepared to hopefully profit from the next round of reports, which is always just a few weeks, really just a couple, 3 months around the corner.
For instance, we will head into the next big earnings season in July. And if you look at the stocks that are in the IBD 50, your weekly review, the Big Cap 20, you go through all of our lists, including the IPO leaders, you literally can make a list of when they all are going to report. And when we had Arusha on, we described that we do, both of us, in fact, I think all three of us, print out from MarketSmith all of the earnings that are going to be due, for instance, from the IBD 50. So I'll have a whole list of when those are due. Now, they are also listed in the paper, so you're going to be alerted as to when these stocks are going to report each and every week. In the B section on page B2, you'll have a nice list of what's going to report that week. But what Matt was talking about, what I use the time for in between, obviously I'm always still looking for stocks on the move. I'm looking for stocks that are moving up on big volume. I look at that in the paper and I look at it at investors.com. I check that all the time because that tells me in between this earnings season, as Matt said, is there any news that's coming out? Maybe Tesla made an announcement. Nike had something happen this week with their apparel. They're going to be on the NBA official apparel. I'll also keep track of what are the newer IPOs that are coming out, and each and every week I look at those. Now, I'm not buying them the very first day that they come out, but I want to see what got some really big fanfare. We had Dave's Tea that got a lot of, there was a lot of buzz when it came out. It doesn't mean that that stock will work out, and it doesn't mean we have to wait for it to form an IPO base. There was another IPO that came out on Thursday of this week, and that one had to do with the treatment of Alzheimer's. And I'm not even going to mention the ticker because, of course, it's just a couple of days that it's been out. So that's another thing that I do in between earnings. I want to see what's the new fresh blood coming into the market, what are the new IPOs, and that's just something that's part of my regular routine.
And a big part of this, like all things with investing, is to stay in sync with the cycle of the stock and the cycle of the market. So, for example, let's say you're looking at a stock that is forming a base ahead of earnings, and then it reports well, it breaks out, and you buy that stock. Now, one thing you have to understand is after that, it may be a while before that stock has another catalyst that can push it higher. So let's say you buy the stock, you get a nice gain within a week or two of, say, 10, 15%, something in that range, and then it starts to trade sideways a little bit, maybe even pulls back a little bit, comes back closer to the buy point. This is where the conviction can really help you. You have to understand first that it may be a while before, again, there's another catalyst to push that stock higher. So it may be challenging to hold that stock during that period, but this is why we talk about all the time, you want to have good conviction in a stock before you buy. Before you jump in, do you really understand what the company does, what the earnings is? Did you really study the chart to see if there was good institutional buying in that? On the breakout, was it particularly strong volume? How is the market doing? When you put all of those pieces together, they all align, you buy in a breakout and the stock goes up, then it's easier to hold that stock as maybe there is that laggard time between that earnings report and the next one that is 3 months away.
And stocks will do different things on earnings. Now, for instance, if a stock is early in its move, okay, we're talking about a newer IPO or a stock that hasn't been public for very long. Let's talk about Facebook. If a stock is earlier in its move, remember when Facebook first really started reporting those good earnings numbers, that is when the stock took off. We had July 26th, this was 2013, it was up 31% for the week, and after that, it did climb. Okay, that was a stock that did continue to go up for several weeks in a row before it formed its next base. You will have other stocks that report earnings that basically go up, they might have a nice move up, and then they almost flatline. They're just holding tight in a pattern. So Your job as an investor in between earnings is you're just watching that and you're seeing if little by little if it goes higher. Netflix did very well in its most recent report. And then, of course, some news came out this week that say that they had added, even more subscribers and they had expansion plans and more of that. Of course, the stock went higher. Now, that's a move that took place in between the earnings. That's what Matt's talking about. So if you have these stocks on your watch list or maybe you have a position in them, you're saying, oh, wow, okay, that was a good move. You're still holding on to Netflix. Maybe you added a little bit to your position at that point. And you'll have some other stocks like Skechers that report earnings. We had February 12th, they had an earnings beat, and the stock was up 16% that day. On April 23rd, again, they had another earnings beat. It was up 14%. And you can see that the catalyst for this were these huge, humongous earnings numbers, 386%, 104, 71, and 80%. So as Matt said, are you understanding the growth that Skechers is undergoing? What are they doing well? And, maybe if you missed part of this run, go study what they're doing. What kind of shoes are selling the best? Is it the Skechers Go Walk? Is it their running shoes? What is it that's causing this company to sell their products?
And I mentioned earlier that part of doing this is to stay in sync with the cycle. And one thing that you're trying to do in terms of that is to build a profit cushion before the next report. So if you get into a stock that breaks out on an earnings report, hopefully you're going to have a decent profit before it reports the next time. Of course, it may be a stock where you're happy with the 15, 20, 25% gain and you get out, take your profit at that point before the next earnings report, maybe before the stock starts to form another base. Or it could be one where you believe in the long-term potential of that company. All the things are lined up, earnings are rising, the stock had a very solid breakout when you bought it, it continued higher, it's still showing healthy trading. Maybe you're going to sit tight in that. And again, even if it does form maybe a flat base or something, a correction that doesn't have a big decline in it, maybe you'll have enough of a profit cushion going into the next report to sit tight and see how that plays out. We've done several shows already on how to get ready for earnings season and things you have to think about in terms of, are you going to sell or are you going to hold ahead of earnings? There's a lot to think about on that regard too. But the point here is, between earnings seasons, hopefully you're building up a profit cushion, and that will take some patience. You have to give stocks a little bit of time to move higher. They don't just keep going up, up, and up. They're going to pull back in many cases, maybe form a new base. And you mentioned several stocks there, Amy. Another one is Monster. If you look at that, it had a history of making a big move on earnings, a really nice gap up, and then just going sideways for a while. That sideways action is actually healthy. Tight trading, sideways after a big gap up on huge volume, shows you that those big investors who just bought are not selling, and they're probably quietly accumulating more shares.
Absolutely, Matt. In fact, we have the chart here right in front of us. You would have seen that Monster gapped up last August on earnings. It was up 26%. From the base breakout, you've got it had a gain of 26%. Bam. Okay, that's great. Then it literally, as Matt said, it went sideways. And it did the same thing when it reported earnings again in March. It had this beautiful gap up, and then it went just absolutely sideways. Now, here's the issue. Depending on how much you're sitting on, you have to be careful because in its most recent report, it fell apart. So if you're not sitting on too much of a gain and you're studying your stocks in between earnings season, you have to be prepared. You remember we had Lee Tanner on, and he said that he needs to have a cushion before he will hold on to a stock throughout earnings.
A big cushion. He talked about how he doesn't want to hold at least not his full position through an earnings report if he's not willing to take a 15% gap down after the stock reports. That's a pretty severe drop. It does happen, as we've seen recently. It does happen. So his approach is, what's the worst case scenario, and am I willing to sit through that?
Oh, and you know what? I'm sorry I didn't mention one thing. If you want to know where I look for some of the newer IPOs that are yet to come out, we have that listed every single day in the paper. So go look at that page. You can see the price of how some recent IPOs are doing, how they're performing, and then you can look at the ones that are due to come out. Maybe you go read a little bit more about the company before they come public. And again, this is not so you're going to jump on it in the first couple of days of trading, but it is so you can be aware of some of these stocks. And once they come public, you can then follow them on a chart and see how they're doing.
Okay, so we'll take a short break and then we're going to come back and talk more about what to do between earnings season to make sure that you're ready for the next round of earnings reports. So LinkedIn is another stock that gives some good examples on how you can prepare for the next earnings season in that interim period between two different reports. So in the case of LinkedIn, if you go back to February when it was getting set to report its latest numbers, it was forming a base. So that's something you could have had on your watch list before it reported.
Now, sometimes these stocks kind of muddle along. So in September, October, November, December, and January, LinkedIn was forming a base on base on base structure, which means it would kind of get to the point where it was going to break out, and then it just kind of slid back down again. It tried to break out again, formed another base. So it wasn't making much price progress. But then we finally got this earnings report February the 6th, and boom, that baby came out, popped up on earnings, big gap up. And the volume was 6.9 million, so that showed there was good institutional buying. And by the way, if you have a stock that has an average daily volume of 1 million or more, that's institutional in quality. Because the pros have to be able to get in there. You think about if you have tens of millions of dollars and you want to take a position, you want some of these big liquid names, the Amazons, the Netflixes. These are the stocks that are very liquid that they can get into. But when they get out, you can also see a huge spike in volume as they dump shares massively.
And we did see that later for LinkedIn. But before that, let's talk about that big gap up and a breakout on earnings. Now, this is something that will come up fairly often is, can you buy on a big gap up? Well, the answer is yes, but you have to look for a few things. Now, the typical buying range is up to 5% above what we call the ideal buy point. So in the case of Netflix, that was $243.35, 10 cents above the peak that was on the left of the base it was forming. But it gapped up and it opened way above that 5% limit that we typically put on a stock, because you don't want to buy a stock when it's what we call extended. It's really getting too far away from that original buy point. But there is an exception for that kind of huge volume, big gap up, especially if it comes on a good, solid earnings report. But as Amy said, you want to focus buying gap ups for stocks that are liquid. And it's not the same if it's a really thinly traded stock.
And keep in mind also that gap ups will work better earlier in a stock's move. Now, LinkedIn had already, in the couple of years prior, they had reported those triple-digit earnings numbers. I think 6 out of 7 quarters were triple-digit gains. That's when the stock was really making its move. And then, of course, the earnings slowed down a bit, and the number of people signing up to be on LinkedIn or to use their services slowed down. Sure. And when they didn't have that huge growth ahead of them, that's when, want to be careful. So let's say you bought that gap up. Well, the stock was actually in a very gradual downtrend. In fact, you probably would have been below what you paid for the stock heading into that next earnings cycle. In that case, you want to be very careful. That was one thing that Lee Tanner talked about, was having a cushion before, if you're going to hang in there with your stock, how much of a cushion going into earnings do you have?
Right, and Lee talked about how he wants to have at least enough cushion where he could survive a 15% gap down in the stock after it reports. So his thinking is, I want to be prepared for that worst case scenario.
That's right,
and
being prepared.
And if I'm not willing to sit through that, I should, at a minimum, reduce my position and reduce my exposure. But back to the idea of a gap up, the reason it's okay to buy into a big gap up on heavy volume on an institutional quality, very liquid stock is that in most cases, not all, as we'll see with LinkedIn here in a minute, but in most cases, that kind of power behind the move, the institutional buying behind the move, typically means that the stock is going to continue to head higher from there. So that's why in that situation, it's okay to buy above the normal buying zone. But as Amy just said, after that, LinkedIn started to trail down. And by the time it was getting ready to report again, chances are, if you had bought on that most recent breakout, you were probably sitting on a small loss because you had to buy into that stock on that gap up, which was way above the buy point, and the stock had been pulling back rather than going higher ahead of the next report.
And of course, when it did report earnings, then you got a gap down. If 18% down, They missed views, and there's not enough new users. And so it was also below the 50-day moving average. And so, it wasn't forming a really great-looking price consolidation when it was in this downtrend. And it sold off on monster volume. So between earnings, look for these stocks that are forming a base. Now, in the case of Netflix, it was forming a nice, beautiful cup with handle base. And then the exact breakout of the stock, the buy point here from the cup with handle was 486.60. And bam, it came out. Those earnings numbers were, they added much more international users than were anticipated. And then it had another gap up, Matt, that you and I were talking about off air here. It had a gap up within the base.
That's right. And that was a good telltale clue. Now, that earlier gap up in January also came on the earnings report. Again, that is a major catalyst. But at that time, Netflix's chart really wasn't in a proper buying zone. But by the time the next report came around 3 months later, it was. So it's something you could have had on your watch list. And that telltale clue in the base, that big gap up, is a classic sign of institutional buying. So that's something that is great to see in the base, as now you're looking at that stock as a possible buy on the breakout. But just like LinkedIn, Netflix gapped up on that breakout. So you could not have bought it in that 5% buying zone. You'd have to buy it higher. And in the case of Netflix, the opening price was around 9% above the actual buy point. But again, liquid stock, it had good growth potential, it's an innovative company, and that volume on the breakout was huge. So it's something that you could have bought into on that breakout.
And the volume was 9.6 million. Okay, when the gap up within the base, that is just institutional in quality. There's no other way to say that. And then the volume really quieted down in between as it was, was kind of moving a little bit higher and completing the base pattern.
And one important point on the volume, you just mentioned that on that gap up, Netflix traded 9.6 million shares. That is, by any standard, a lot of shares. But the key is you want to compare it to the average daily volume for that particular stock. And if you do that, that volume represented a 528% increase for Netflix. That is a huge difference. So it's not just the number of shares. You want to see how that compares to the average daily volume for that stock. You're looking for unusually heavy volume, and it certainly was unusually heavy volume for Netflix on that gap up.
Now, one thing that Matt and I have gotten some questions on, if you said, yeah, but Netflix had negative numbers. Their earnings were negative 9%, negative 10%. So why then did the stock do so well? Because normally with CANSOM investing, we're looking for those huge earnings numbers. Well, in the case of Netflix, this is an example of that they added more subscribers internationally than was expected. And that was huge, big news. They had covered the market here in America, and now they were expanding into Europe.
Right, and one analyst this week talked about how he believes that Netflix subscribers in Western Europe will jump from 3 million in 2013 to 21 million by 2019. That's a sevenfold gain, and that's a reason why maybe they're overlooking the costs of that expansion that are reducing earnings now for big earnings down the road, hopefully.
And in our paper just yesterday, there was a report saying that Netflix had made a deal with Brad Pitt to produce a $30 million film. So see, Netflix is doing all these new, innovative things. Reed Hastings has proven over and over again to be a pretty formidable CEO.
To wrap up, we'll have notes about how to get ready between earnings season on our website, as well as some markups for some of the charts that we were talking about, like with Netflix and LinkedIn. And you'll find that at investors.com/investingshow.
When you start investing, it's critical to have a game plan for success and a simple routine that fits your schedule. With Investors Business Daily, you get both. The Market Pulse shows you the right time to buy or move to the sidelines. Unique lists like the IBD 50 highlight stocks that could be on the verge of a big move. And IBD Stock Checkup gives you pass or fail ratings for any stock before you buy. Get a free trial at investors.com/radio show. That's investors.com/radio show.
Now, the final segment of How to Make Money in Stocks with Investors Business Daily.
There are some interesting IPOs coming up next week, including Brazilian steakhouse Fogo de Chão. So remember, we have that list in the paper every day in the New America page.
And to check out show notes for this week's episode, as well as links to the Investors Corner series and our E3 special report that's coming up, go to investors.com/investingshow.
Okay, see you next week, everybody.
You've been listening to How to Make Money in Stocks with Investors Business Daily, featuring Amy Smith and Matt Galgani. For more stock ideas and investing strategies, and to subscribe to the free podcast of this show, log on to investors.com/radio show. That's investors.com/radio show.